Hello, everyone. Welcome to episode number 29 of Great Quarter Guys. This is your host, Andrew Cox. I'm here with my boss and my man, Kevin Hill. How are we today?
We're doing great today. We are doing great today, ready for a great show.
Yeah, we got a big one lined up for you. We've been doing earnings recaps for the last couple of weeks. We've decided to go a little bit of a different route today. We're going to have our man Ryan Schrieber from CarrierDirect on. We're going to talk a little bit about different strategies that we think that we've seen that will be the best to get out of this recession. What do companies do that end up becoming stronger through a recession and come out as market leaders? What are their strategies that they employ? That's what going to be the main topic of our discussion.
It is, and it's based on somewhat based on a Harvard Business Review article that we all three of us read recently, and it's all about going into a recession, coming out of a recession, what strategies worked best for the winners coming out, the ones who grew sales, grew profitability the most rapidly. And, is that being proactive, playing offense, defense? Is it a mix of both? Sounds a little like football as well.
Yeah, it will definitely. I think it's going to be a mix of both. We'll have Ryan on here after our first commercial break in a few minutes to discuss that. But before we get into that, we'll talk a little bit about updates to our last week's long and long shorts. They were both long-term ones, but it's fun to talk about it a little bit, see where the rumors have moved in the past week. We talked about two possible acquisitions. The first one was Amazon, the rumor that Amazon may be circling around AMC. That one's kind of fizzled. I haven't heard much of that since we last reported.
I haven't heard anything about it myself.
But the other one is that Uber was looking to acquire Grubhub. This would make by far the largest food delivery service in America. It would take up 90% market share if that were to go through. I've heard continuing rumblings of that, but we've also heard a lot of other news about Uber coming out this week with more layoffs. And we just heard from Bill Dreigert that Uber Freight is focused on profitability and focused on the future, but we hear conflicting messages around it. So who knows what Uber's doing right now?
Yeah, Wall Street Journal came out with an article announcing a new round of layoffs. Takes Uber up to about 20% layoffs. Reinforces the Grubhub kind of rumor that's out in the market right now. So you have those two pieces, and going into a recession, and they are looking where to cut costs and make their bets. And we had Bill Dreigert, who runs Uber Freight, on the coronavirus freight market update a couple hours ago, our noon show, and that's on demand. So you can see that interview is at the 12:40 mark, or around the 12 or the 40 minutes into the show mark, where we interview Bill about Uber Freight, and the story of their demise is over exaggerated, as Mark Twain said. So you can see that on tv.freightwaves.com.
Yeah, of course Bill's going to have to come in and be positive, but he did give me he was very encouraging and made me think that Uber Freight, it may actually survive this. They may look to get rid of the autonomous vehicles market or some of their other big bets. They have a lot of places they've gotten into. They've recently gotten out of the jump bikes and scooters. They've gotten out of different markets like India and China. So we don't know if Uber Freight's on the chopping block, but he seems confident, and I don't think they are, actually.
Yeah, and I think it has a lot to do with how rides recover. They were down 80% rides. Their main business line was down 80% in April. So we'll see how that recovers and how that generates cash flow for all the other big bets. But the Harvard Business Review article that we're referencing, it kind of goes hand in hand with Uber's position right now, where to basically play offense and where to be defensive.
Right. No doubt. So let's move on to one good piece this week before we move off to a quick commercial break and bring Ryan back in. So my one good piece this week again, guys, I don't know what to tell you, but this data keeps getting better. The Bank of America credit card and debit card spending data, that is what I'm referring to. We can flash it up here on the screen here, and you'll take a look while I talk through some of these things. We'll start from my key takeaways from the very bottom. The last line, the total card spending is only down 10% year over year for the trailing 5 days of the last day of data we have, which is the 7th of May. That's a major improvement from the previous week when total card spending was down about 20%, and that's up from almost negative 40% in the first week of April. So a massive growth in the end of month of April and into May. The next thing I want to look at is that retail spending, excluding automobiles, it's now positive year over year. This is absolutely astounding to me. I would have never guessed that retail spending would be up year over year during one of the worst recessions we've had in many years. So I'm very happy to see that. That gives me a lot of confidence. Number 3 is the restaurant spending is now up to 2/3 of pre-crisis levels, meaning that we've returned a little bit to the restaurant already. They're gonna have less capacity. They're not gonna that number's not gonna pop up to 100% as quick as the others. And then the last one is that online electronics number, which we'll discuss a little bit more in more detail later on when we do some long shorts. But that's been crazy growth.
And I guess home improvement is still roaring along.
It is, yeah. It's still up 30%.
The one big bright spot. It's consistently been up 20-25% since this pandemic, and I guess that's what happens when everyone has to stay at home. They start renovating.
Yeah, they start renovating. They had to start cooking at home. The grocery spending has returned after a little bit of a lull there in April. It's now up 30% year over year. So. You're seeing that pop back up, and I'm just amazed, Kevin. What do you make about retail spending being up? I mean, over 2% for the last 5 days of our data.
Well, another interview that we did on the coronavirus freight market update was Lorianne LaRocca.
Right.
And she has some really good consumer data and freight flow data showing that a lot of those are essential and consumable items, and that the department stores, and I can see it right here on the chart, department store retail sales are way down.
Yeah, for the trailing 5 days, at least 35% down.
40%. So you have a mix. So the mix is changing from discretionary or clothing kind of retail brands to those essential items, and I think that's a good narrative to put on that, is that the spending is up, but it's shifted to essentials.
Yeah, and I'm glad you mentioned that, especially away from department stores, because next week we're going to have Seth Holm on, another person on our team here. We're going to talk about the kind of the future of malls and how this mix of online spending is becoming a higher mix of total card spending, and what's that going to mean for malls. We're seeing massive closures at JCPenney and Neiman Marcus and other stores. So what is that going to mean for malls?
And we have some really good charts that we're going to roll out next week, describing and really gives great visuals on how e-commerce has changed in the last 10 weeks and how that's going to be a wave of the future, and restaurants as well.
Yeah, so definitely restaurants. I think Seth covered consumer staples and consumer goods at a hedge fund for nearly 10 years, so he knows this market better than anyone here. So he's going to be there to give us some insight into the malls and some restaurants. But we will be on that next week.
Restaurant expert.
Yeah, I mean, I do restaurants. Yeah, I think I have a little business, but we'll be back right after this break, guys. Thanks.
Yes.
All right, welcome back to Great Quarter Guys, episode 29. We are about to jump into our discussion with our man Ryan Schrieber from CarrierDirect. I think he's joining us now. How are we today, Ryan?
Good. How are y'all?
I'm good. I can see the beard is still going strong. No shaving that thing.
Still going strong.
By the beard of Zeus.
My wife every single day is trying to convince me to let her trim it. I said she lets me trim her hair. She can trim my beard. So far, no go.
That does seem like a fair. That seems like a fair bet, a fair exchange.
Yeah, right. She's not a sports fan, so she doesn't get the playoff beard, the Corona beard. She doesn't get it. So.
Right. Well, cool. So let's jump right into this discussion. This is based on, we're basing this off this HBR article that you shared with us that we wrote, and this article was really talking about an empirical study that these two researchers did on the different strategies that companies employ to survive through a recession, and how they get ahead during a slow growth, and then how they're ready to win when the times return. So they analyzed 4,700 public companies during 3 recession times: the 1980s crisis, the 1990s slowdown, and the dot-com bubble burst in the 2000s. And they studied these companies for 3 years prior to the recession, the years of the recession, and then 3 years post-recessions. And their findings were quite stark. So 17% of those companies that they studied did not survive one of the recessions. And 80% of the companies never reached, or after the 3 years, hadn't reached their pre-crisis sales and profits levels that they had 3 years prior. And then only a small number flourished. It was 9% of the companies who actually were able to emerge as a market leader, and that's who we're here to talk about today. So to start it off the top, why did those 9% flourish and the others did not?
And just to highlight, it's roaring out of the recession from the March 2010 edition of the Harvard Business Review. Go ahead, Ryan. Sorry.
No, yeah, I mean the nine flourished by being really, really intentional, right? 21% of firms were able to pull ahead of their competition if they cut, which was the lowest amount of companies or of of success. And so it was really about an intentional mix of playing offense and defense. I posted about this on LinkedIn earlier this week, where the companies that really succeeded, their mentality was different. Instead of saying we need to get from $5 to $1, or instead of saying we need to spend more and be really aggressive, that only gave you a slightly better opportunity, 26%. They said we have $1. We have $1 to spend. What's the company we need to be in the future? And how do we invest in certain places and cut in other places to make sure we get there?
And that is the mix between offense and defense that it talks about in the article. Yep. A lot of times you have wasted money on wasted projects or things that maybe your cash generators of the present and the past, but maybe not future. I mean, you take a pandemic like we're going here, and we've been talking about retail and restaurants and all kinds of different businesses, that the future is going to be much different than the past.
Yeah, absolutely. It's even more important when we look forward to have flexibility, right? I mean, consumer preferences have been shifting incredibly quickly. They'll be shifting even more quickly now. Supply chains are going to be changing, and we're not sure what that's going to be. So as an example of, trucking companies that are going to go out and buy a bunch of new trucks, that might not be the best strategy in the future, because capacity, having those trucks may not be the best way to win. You've got to really look forward and say, what's my advantage and how am I going to invest in that to be the company I need to be in the future, not a better version of the company that I am today.
So you say that, it needs to have this progressive or this pragmatic approach where they have to play offense and defense. Let's talk about the defense a little bit first. So talk about some of the problems with just going after cost cutting. And I guess my thing is that my takeaway from this was that they need to focus more on efficiency, on operational efficiency, rather than trying to do more of the same with less people or with less money. Would you consider that correct?
Yeah, absolutely. I was just on a call right before this with the Foundation for Strategic Sourcing, which is a large trade organization for manufacturers, CPGs, and contract manufacturers. And I talked with them about how their business is focusing on how to get drivers in and out more quickly is even more important now as they're thinking about how to not have how to limit exposure. But even second level things, right? Like how to dynamically deal with appointments, because they can't resource people in the warehouse the same way they used to. So really drilling in on those efficiencies from a defensive perspective and being intentional about what the reality is in the future to invest in those efficiencies.
What do you think? If we just go back to supply chains, I mean, there's definitely every supply chain's been stress tested over the last 10, 12 weeks. And the supply chain is going to look different coming out of this than it did coming into it. So would you say that the best offense-defense play is to adapt to that environment smartly and create efficiencies that way? Absolutely.
It's about prioritization. I mean, a lot of the work that we've been doing recently with our customers is around prioritizing the parts of their business. And so flexibility, I talked about a minute ago, but the other part is flexibility, Kevin. So, is prioritization. Mm-hmm. So absolutely. Every business is different. Every business has different needs. And so there's not just one solution for all. That's the problem with just slashing across the board, right? Because your business needs something different than somebody else's business. You need to prioritize your cuts and also prioritize your offense.
Yeah, I'm glad you said that, because one of the other things that I've noticed with cost cutting across the board, it's typically done by the finance department, and they don't often discuss it with all the other different divisions within a company. So it's sometimes people that don't know exactly what that company or that division brings to the table that gets slashed. But another thing that I wanted to discuss with you was that there was a certain subset of those progressive winners that had the highest probability of winning, and those were people that they were really selective about their defensive moves, but they were quite comprehensive in their offensive moves. They developed new business opportunities looking for different markets. They increased R&D and marketing than their competitors. So talk about that difference between being really selective on defense but being pretty comprehensive on offense.
Yeah, it's again, it goes to that idea of looking through the windshield and figuring out who you need to be to service or to be the business that you need to be in the future. Again, like not about being a better version of the business you are today. What this new reality, what new markets are going to open up for you, right? As an example of some of the things we've been helping our clients with are things like what are your strategies for using nearshore and offshore for some of these really low friction low friction jobs to be able to use that for, right? You're going to be cost conscious. You need to be more cost conscious in the future. And so how can you do that aggressively?
Thank you very much, Ryan. We're about to go to a break here in 30 seconds.
Welcome back to Great Quarter, guys. Apologies on that little mishap before the commercial break. Luckily for us and for everyone watching, that is the last commercial of the day. We still have Ryan Schrieber on the phone. We're talking a little bit about the different strategies employed during a recession by different companies. Let's talk a little bit about the problems with being too aggressive, Ryan. What are the problems that positive groupthink and everybody gaining some sales during the recession can do to a company? What's the problem there?
Personally, I think the natural inclination is to be overly conservative. So if you're going to be one or the other, I think it's better to err on the side of being overly aggressive. And the data did bear that out. 21% versus 26% of companies who were the first number being overly conservative and the second one being overly aggressive. But it goes back to the whole point of being intentional. If it's a scattershot approach, and so it's essentially just luck whether you happen to do it correctly or incorrectly in terms of who you want to be in the future. So really, what this article says and what we've been seeing recently is how to prioritize, how to be intentional to make smart investments in who you want to be in the future.
So Ryan, CarrierDirect is a consultant. What are you finding out, because you're out there talking to a lot of trucking and logistics companies, on the spectrum of offense and defense and progressive, where do you find most companies in trucking and logistics?
Yeah, just like the rest of the general economy, and just like what you saw in the article, most companies are being overly conservative, right? Most companies are slashing. Most companies are going just into a shell, and certainly they're trying to make insightful choices about where they cut, but that's really difficult. If you just go in and you say, I've got to cut $4 out of my budget, you end up making really, really tough choices, and they can't always be right. There are still a lot of companies making smart investments. There are still companies who want to be who are making investments. Some really interesting stuff that we're seeing, people taking a really insightful look at their compensation, particularly on the intermediary side, because you know that you're probably paying a lot of order makers like order takers like order makers, and you're not paying order makers maybe enough to incentivize them to make orders. Your operating model might not support that. That's some interesting stuff we're doing. And then I mentioned offshoring strategies earlier, and then those investments in technology. So if I'm going to spend, and I know that I'm going to spend right now, let me make sure that I'm making safer bets in that spend right now.
Most certainly some difficult decisions happening right now throughout the market. Thank you for talking about that. Let's talk about a little bit of a difficult decision for you. We got our long shorts coming up. Are you ready, Mr. Schrieber?
I'm ready as I'll ever be.
Okay. All right. So we've got two for you today. I've got two companies. We're going to do companies rather than ideas today. The first one is a company that's basically benefiting from the alternative meat sale right now. The alternative meat sales are up 300% year over year through the first for the first 9 weeks of April and May. This company also did a quick deal with Starbucks in China and also did a deal with McDonald's. This is, of course, Beyond Meat. We have a lot of things going on with the meat factory plants having, a lot of COVID-19 cases, and they've haven't been shut down. What do you think, Ryan? Are you long or are you short the idea of Beyond Meat being a competitor for Tyson, to be a real competitor in the meat market?
Yeah, you know what? I'm really, really, really long on meat alternatives, and I'm an avid meat eater myself. But knowing how difficult meat is on the environment, raising meat and then consuming meat, it's really difficult. And so I think I certainly am very, very long on what they can do, because I think more people are going to care about that, particularly younger generations, as they come up with the idea that meat alternatives is a more normal solution, as opposed to older people like me who just want my steak.
Kevin, what about you, man?
I'm kind of short. I think the alternative will grow and grow, but I think people, we're built to eat meat. Steaks, right, Ryan? Steaks and bacon and all of that. So I don't think that's going to get phased out at all. So
I'm with you, Ryan. I'm long as well. I think not only am I long the idea of alternative meats, I'm long the company. I think Beyond Meat is well positioned. I think they've got good management. I like the deals they're doing with Starbucks and with McDonald's. They're also actively lowering their prices to try to compete with beef, because beef is just super cheap. So I like what they're doing. I'm long them. The next one is Best Buy. So this is coming on the heels of that online electronics line on the Bank of America data being up 150% year over year. Online electronics are through the roof. There's a bunch of new gaming systems coming out, Xbox and PlayStation, and the gaming industry is growing. So, Mr. Schrieber, are you long or are you short Best Buy? One of the massive big box retailers in the U.S.
Had I not heard what you said a little bit ago about consumer spending, I probably would have been short on this. But hearing that consumer spending is actually pretty robust as compared to what I would have thought it was without that data, I'm going to be long. I'm going to be long on it. I think that they certainly need to adjust their strategy going forward to more of an e-commerce footprint than a store footprint. But I certainly think that is an opportunity for them, and I think that I'm going to be long on it.
I'm long on Best Buy too. I think curbside is a new e-commerce because whenever I order anything from Amazon now, it takes 2 or 3 weeks to come in. If I can just order online from Best Buy, go drive curbside, they'll put it in my back seat and off I go. I think I'm very bullish on that. So
the click it and pick it kind of thing. I like it as well. I like Best Buy. I don't think I would have been long a couple months ago, but after seeing that electronic data, the electronic online spending data go through the roof, I'm long as well. I think gaming is going to continue growing, obviously, especially I think COVID's even sped that transition up. So, yeah, I'm very long Best Buy, and I'm long Beyond Meat as well. But before we go, I wanted to thank you, Mr. Schrieber. Thanks for joining us today, my man. Hope you have a good week.
Yeah. Thanks for having me again, chatting about this. I'm glad you guys enjoyed the article. We'll talk again soon.
No doubt.
Definitely. And you can find Ryan on LinkedIn at Ryan Schrieber, CarrierDirect.
All right, so what's on the docket tomorrow? You guys are talking to put that coffee down?
Yeah, we're talking to truckstop.com, Trent Broberg, and talking about returning to normal, maybe ending the work from home, bringing people back into the office, and how that mix is, and managing in a crisis that we've seen in the pandemic, or this pandemic for COVID-19. So be very interesting. Dune and I will be out and in front and talking about sales.
Yeah, so we got a paper coming out later this week. Look out for that. We're going to compare OTVI and the consumer spending data. Y'all have a great rest of your week. See you guys.